Cost classification in accounting might sound like a dry topic, but it's absolutely crucial for any business, especially if you want to keep those financial numbers looking healthy and your decision-making sharp. Think of it as the backbone of financial accuracy and strategic planning in manufacturing and merchandising. You might be wondering, what's the big deal about classifying costs? Well, let's break it down together. At its core, cost classification is about dividing expenses into two main categories: product costs and period costs. Each of these categories plays a unique role in how we understand a business's financial health. So, let's dive into product costs first. Product costs, often referred to as the cost of goods sold or COGS, are the expenses directly tied to creating a product. Picture this. You're a furniture maker. The wood you buy to build that beautiful dining table? That's a direct material cost. The wages you pay to your skilled workers who assemble that table? That's direct labor. But it doesn't stop there. We also have manufacturing overheads, which are those indirect costs that you can't directly trace back to a specific product. Think of utilities in the factory, or even the salary of the production supervisor. Now, why are product costs so important? They help us determine the value of our inventory. When you create a product, all those costs accumulate and sit in your inventory accounts on the balance sheet until you sell the item. Once it's sold, those costs move to the income statement as an expense. This is where it gets really interesting. Understanding product costs allows businesses to accurately assess profitability. If you're a merchandising company, your product costs are a bit simpler. You're buying goods for resale, so your costs mainly include what you paid for the merchandise and any freight costs to get those goods to your store. Now, let's talk about how product costs contribute to the valuation of finished goods and work in progress. For finished goods, product costs include everything incurred to bring those goods to a saleable state. So, when you're valuing your finished goods, you're looking at all the direct materials, labor, and a portion of manufacturing overheads. And for work in progress, or WIP, it's similar, but focuses on the costs for products that aren't quite finished yet. This valuation is critical for accurate financial reporting because it represents an investment that hasn't yet turned into a finished product. But what about period costs? These costs are a different beast altogether. Unlike product costs, period costs aren't tied to the production of goods. They're expensed on the income statement in the period they occur. Think of things like office salaries, advertising expenses, or even the depreciation of office equipment. These are necessary for running the business, but don't directly relate to production. So, why do we exclude period costs from inventory valuation? It's pretty straightforward. Period costs don't have a direct association with products. They're not expected to bring future economic benefits like product costs do. This is where the matching principle comes into play. We want to recognize expenses in the same period as the revenues they help generate. So, when period costs hit, they impact the profit and loss statement right away. Now, let's consider the impact of period costs on profitability. These costs can fluctuate significantly from period to period. Imagine you launch a big advertising campaign. That's a period cost that could reduce your profits in the short term, even if your sales and product costs remain consistent. This is where management needs to step in and monitor those period costs carefully. They're often strategic decisions that can support long-term growth, even if they cause a dip in short-term profits. As we look at financial statements, we see how product and period costs intersect. Product costs are crucial for calculating gross profit. They're recorded as assets on the balance sheet under inventory and only recognized as expenses when the goods are sold. Meanwhile, period costs are expensed immediately, impacting the net profit right away. Let's break this down with a hypothetical example. Imagine a manufacturing company with total manufacturing costs of $1 million, which includes direct labor, direct materials, and manufacturing overheads. If they have non-manufacturing costs, or period costs, of $400,000, we can see how these numbers play out in the profit statement. The sales revenue is $1.2 million, and from that, we subtract the cost of goods sold to find the gross profit. After factoring in the period costs, we arrive at the net profit. It's all about understanding how these costs interact and impact the bottom line. Now, let's switch gears a bit and talk about merchandising organizations. They operate differently since they purchase goods for resale rather than manufacturing them. In this case, product costs are primarily the purchase costs of inventory, which includes the price paid to suppliers and any additional costs to get that inventory ready for sale. When we calculate the cost of goods sold in a merchandising context, it's all about the opening inventory, purchases during the period, and the closing inventory. It's a straightforward formula, but it's critical for determining profitability. The closing inventory must be accurately valued to ensure the balance sheet reflects the company's financial position correctly. Service organizations add yet another layer of complexity. They provide intangible services rather than tangible products. Here, direct costs often relate to labor, and the classification of costs revolves around those direct costs of service delivery and the period costs associated with running the business. WEP in service firms represents the value of unfinished services and is treated similarly to WIP in manufacturing. So, why is all this cost classification so important? It's not just about compliance with accounting standards, it's about making informed decisions. Accurate cost classification allows businesses to set strategic prices, create accurate budgets, control costs, and evaluate performance. Misclassifying costs can lead to misstated financial statements, misguided management decisions, and even tax implications. Consistency in applying cost classification principles is vital. It allows for comparability across periods, enhances the credibility of financial statements, and provides better predictive value for future performance. It's all about maintaining integrity in financial reporting. In conclusion, understanding product and period cost classification is foundational for any business. It's about more than just numbers. It's about making informed decisions that drive growth and sustainability. By classifying costs accurately, companies can achieve a true representation of their financial performance and set themselves up for success in the long run. So next time you hear about cost classification in accounting, remember, it's not just a dry topic, it's a vital part of running a successful business.